Getting to today's market recap, so today, yesterday we sort of had this nice sort of a rally that sort of continued on and on. We finished in a position of strength right at that 2750 level, which we've talked about for a while as being a key resistance level, sort of that 2700 to 2750 range. We sort of blown right through that, and as you can see, looking at the daily chart, and we're just going to update it for today's close, you can see we really were sitting on there yesterday and the day before, right at 2750. That's a Fibonacci level coming from the 2018 to 2020 uptrend. You can see today, it's all about follow through, and I feel like we sort of got that. We sort of got that follow through to the upside with the market continuing to make higher highs and higher lows. And as we've talked about on this tactical time frame, I think as long as the market continues to make higher highs and higher lows, that's sort of, that's the most important short-term trend to pay attention to. Now, as we get to sort of what I would argue the later stages of a bear market rally, it's starting to look at indicators and ways to try to understand how far we might want to go. And when we start breaking through resistance levels, I'm looking down at the RSI, I'm seeing it near the 60 point, which generally speaking, in a broad bear market phase, you would see the RSI come up to 60, and that's about it. Usually doesn't go much further than that. So I think we're sort of entering the point where you might expect that to come into play. Below, after that, you're sort of looking at previous times when the markets peaked out to the next sort of short-term resistance around 2870. That comes from a number of different places going back over the last 6 months or so. So we're sort of nearing some of those levels. But again, credit to the short-term strength. We continue to sort of push forward and have higher highs and higher lows. The real test is going to be on any pullback, right? And as we've talked before, as we just jumped out of the lows, the question was, can we stay above 2450? I think you need to bump that up now and see whether we're able to break, remain above the most recent swing low on any pullback. And until that happens, the short term, that tactical trend remains higher. We're sort of combining today our market recap with wrapping the week, just because we're on a long weekend coming up Thursday. So I want to rotate now to just look at some of the longer term charts and see how that short term trends fits into the bigger picture. So this is more of the long term trend that I tend to look at, and again, it's very long term. So this is looking at a weekly chart of the S&P, the 21 and 34 week exponential moving averages, and then a shorter term, sort of the medium term time frame here at the bottom, which is a weekly PPO, or what you might call a weekly MACD, looking at those time frame. So what happened is, as the market sold off so aggressively, going down so quickly in such a short amount of time, it took some time for these trend following devices to really catch up on it. The sort of that medium term time frame turned negative mid-February by my read, using again the weekly PPO. That still remains relatively negative. So on the tactical, the very short term, you know that we've been in rally mode. But on this intermediate term, it's still telling you, obviously, we're in a downtrend. And this is by design. These are not meant to trigger very quickly. It's meant to minimize whipsaws. So it would have to take a little more time. There's a time factor in there before it's going to be able to trigger any sort of buy signal. It's telling you to still be cautious. And the very long-term time frame, sort of the ultra long-term, the secular time frame, by my read, still suggesting we're in a position of weakness. And again, I think that's overall how the market kind of feels. By any measures I've really looked at, we feel like we're in bear market rally mode, not a new uptrend by my read on breadth and otherwise. Those models are meant to try to put a little more rigor behind that anecdotal measurement of where we think we're at. This is the other daily chart that I keep a look at, and again, we're sort of entering that next resistance level, which lines up with support from last August, last October. So previously, that 27 to 2750 range lined up with last summer, March and June. Now we're in the range 20 to 2860 or so. It's sort of the support levels from going into last fall, actually, end of last summer into last fall. That's actually the big initial sell-off we had coming off of the highs in mid-February. We pulled back right around 16%. To this low around 2855, and so again, that's why we're entering this next sort of resistance range. So again, if in a plain vanilla market, if we've now had enough of a bear market rally, we're nearing that point with the RSI, with the resistance that would be about where this thing should end. So I think the question myself and many others are asking is whether or not we're going to get that capitulation to this bear market rally. Now, the breadth picture has actually improved in some ways. We're going to look at a second of the percent of stocks breaking above the 200-day and the 50-day, which I think has improved. But also this one, we've looked at this as a cumulative advanced decline lens. And what I've told you is until we see some improvement here, until we see a reversal from the downtrend in these cumulative advanced decline lines, then the trend is still, there's still this inherent weakness, internal weakness to the market. But if you look at what's happened now, we have now established a higher low, which was the low we had in the last couple of days. We've now, based on yesterday into today, and these have not updated yet for today's close, this is just through yesterday, we've established a higher high with both of these, with the S&P, with the NYSE, with also the mid-cap index, and now with the small-cap index. They've all established higher lows and higher highs in the cumulative advanced decline line. That just sort of confirms we're in rally mode, right? On that tactical time frame. It's sort of pretty encouraging if you're more, trying to look for a bottom being in place. And again, I think number one is price. As long as we keep making higher highs and higher lows, the path of least resistance is higher. This is an interesting one, and I've mentioned this chart a number of times, and I just tweeted out a little bit ago this particular chart and some comments on it. There are two sort of examples of what I've seen takeaways from this. When we first initially became bombed out, and this indicator is the percent of stocks in the S&P above their 200-day, when it really got below 10%, I'm immediately looking back at some of these previous bull market lows, right? So the low December 2018, the low mid 2011. We didn't quite get down there. We only got to 20% here in 2015, 16, but you can see these levels where it gets relatively low, and that ends up being the short-term bottom within this overall bull market phase here. Once we broke below there and started to sit down here, and I've zoomed out a little bit, but we've spent, a month there with, pretty close to zero, less than 10% of stocks above their 200-day. That immediately, to me, sort of disconnects it from these short-term pullback readings, and it looks a lot more like the 2008 to 2009 readings, where it went below 10%, remained below 10% for 6+ months before it finally got back above 10%. And my hunch was, boy, it's starting to look a lot more like that, where it's more of an extended bear market. That tends to take a lot more time. Breadth can remain depressed. I think that's what we're seeing. What's happened, though, is with the severity of the sell-off and now the severity of the bear market rally, all of a sudden it doesn't look a lot like this 2008 to 2009 period anymore. I think is really compelling. I think what's interesting now is it doesn't look like any of these periods. It's not lining up with the short-term, bull market pullback phase, because it wasn't a quick one and done and it got really low. It's no longer like this 2008, 2009 period, because that remained really muted for 6 months plus. This has remained muted for about a month, and all of a sudden it started to pop up again. And so, sadly, I think it is truly sort of uncharted territory in terms of how this looks from a breadth perspective. I think we've run out of recent examples to really compare this to, which is fine. I think we have to fall back to the traditional toolkit, but I think a lot of people are looking for analogs. And I think what this is telling me from a breadth perspective, it's not looking like the short-term pullbacks, and it's not looking like the previous bear market cycles either. I think we're in a new type of environment. I think we're in a new type of bear market rally here. The final thing I want to get to, and then we're gonna move on to our next segment, is just looking at the bull bear spread. This is the AAII rankings. I think it's interesting to note that in the last couple of weeks, the spread between bulls and bears has come off a little bit. It was very bearish, with over 20% more bears than bulls, and we had over 50% of respondents saying they were bearish. That's come off a little bit. It's still 45% of respondents saying they're bearish, but there have been more and more bulls every week. They're getting closer and closer to an even pitch between the two. So even with this bull market, this sort of bull market within a bear, this rally that has been so sudden and so surprising to many, including me, is the fact that you still have more bears than bulls, but not completely switching gears. It's not like everyone's turned bullish again and that there's a euphoria for stocks on the long side. I think there's still overall a skepticism, a pessimism, with almost, with 45% of respondents still bearish. It has not dramatically changed from there. It sounds like it would take more movement to see people reverse their opinion. Again, with these, I bucket something like the AAII survey is more anecdotal. For me, it's all about the trend. It's all about the charts, and it's about what the charts are showing, what the movements are happening in terms of the highs and the lows. And again, by any measure in the short term, the path of least resistance, I think, remains positive until proven differently. So you're going to look for lower high, lower low, and I think we've got a lot of pullback before that would confirm short-term weakness read from a trend following perspective. That's our wrap for the week. And boy, I feel like when there's so many things to do, I just want to finish with one more comment, and then we're going to go to our next segment called Level Up. I did want to point out just very quickly the sectors, because I think as much as today was a bit of an upside follow through, it was noteworthy that for most of the day, the leading sectors were real estate and utilities, the XLRE and the XLU. So I was looking earlier midday, it was like, wow, the market again making new swing highs here, but it's the real defensive stuff that was leading it. Financials emerged during the day and became the number one sector, up over 5% today, which is encouraging. And obviously that's based on, the Fed news and further support for the market should be good for some financial stocks. And if you look at the chart of the XLF, it's actually started to resolve higher. Some of these stocks like JP Morgan, others that I was sort of saying are in consolidation mode have moved up a little bit. But when I'm looking at, looking at this, I'm seeing defensives lead, but financials emerging number one. They have not been anywhere near the top of the list for a while. So that's an interesting sector theme going into the long weekend. Also, number one from the bottom was technology. And we think about the leadership in tech and how resilient that's been. We start to see days where tech is at the lower end of the return list. And we start to question some of the upside here. So again, as much as it should, I feel like I want it to be everything's great, we're in the clear, going positive. I'm seeing sector rotation that feels still a little more defensive than everything's great, and we're sort of betting on the long side. I feel like there's accumulation, but still more on the defensive side, still planning on more backing and filling.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.